And I'm delighted to now be able to hand over the microphone to CeylaPazarbasioglu, who has recently become the Director of the IMF's Strategy, Policy and Review Department and has had quite a lot of experience in the fintech world. So I'm very looking forward to hearing her insights. Thank you very much, Ceyla.
Thank you, Caroline, and thank you, Masa and Greg, and to the OECD for hosting this very important event. I'm very pleased to join you today. This topic is particularly important to me as I served on the United Nations Secretary General's Task Force on Digital Financing of the Sustainable Development Goals. And that was a very intense period of 18 months where we discussed many of the issues that will be discussed at the course of this important event. It goes without saying that digital technologies are really transforming financial services, yet even with all these advances, we see 1.7 billion, about that amount, adults that are unbanked, that do not have any access to a financial institution or through a mobile or money provider. And many small and medium enterprises, which account for 95% of companies worldwide and more than 60% of global employment, still struggle to access finance. So against this backdrop, in 2018, the IMF and the World Bank developed the Bali FinTech Agenda to bring together and advance key issues, key elements for policymakers and international community to weigh in as individual countries formulate their policy approaches to fintech. The agenda includes about 12 elements, and it considers policy design and regulation. It includes using fintech to promote financial inclusion, providing a level playing field for new technology players, enhancing consumer protection, fighting money laundering, developing a robust data structure, which is really critical, modernizing legal frameworks, encouraging international cooperation and information sharing, and ensuring the stability of monetary and financial systems. I'm going to mainly talk about this last aspect today, and as we at the IMF focus very much on the implications on monetary and financial stability and how the international monetary system and global financial safety net is impacted with all these changes. This includes work on topics such as central bank digital currencies, so-called global stable coins, the GSCs, and cross-border transfers of financial transactions. I'm going to get back to these issues shortly, and the next panel will be discussing the financial transactions. I'm going to get back to these issues shortly, and the next panel will be discussing these issues in detail. First, I want to talk about how digitalization can support both growth and greater inclusion. For the last 18 months, as I mentioned, the work of the United Nations Task Force on Digital Financing of Sustainable Development Goals has been exploring how digitalization can help tackle the world's most urgent development challenges. COVID-19 only amplified this mandate. Tackle the world's most urgent development challenges. COVID-19 only amplified this mandate. We found that both public and private sectors, the COVID-19 pandemic has created new opportunities for digital financial services to accelerate and enhance financial inclusion, access to finance amid social distancing and containment measures. So the pandemic actually made this work even more important, and this event is also very timely in that context. These developments would lead to a shift toward digital financial services from traditional services. For instance, the severe acute respiratory syndrome, SARS epidemic in 2003 accelerated China's launching of digital payments and e-commerce. As a result of the COVID-19 pandemic, regulators have been taking action to incentivize the use of digital financial services, and businesses are also moving very quickly to leverage the power of digital technology. To tap the high potential of digital financial services in the post-COVID era, many factors need to fall in place. First, regulators need to keep up with fast-paced technological change, as risks emerging prior to COVID-19 are becoming even more relevant. Fintech, if not regulated properly, could pose risks to financial stability, financial integrity, market contestability, consumer protection, operational resilience, and monetary policy. Activities may migrate to unregulated sectors, increase money laundering and terrorist financing risks, and activities may migrate to unregulated sectors, increase money laundering and terrorist financing risks, and create operational risks related to IT, cybercrime, and outsourcing. So this comes, of course, needs to be balanced carefully because there are opportunities from fintech and using technologies like blockchain, but it's very important that we make sure that the risks are also monitored carefully and addressed as needed. Governments also need to modernize data governance frameworks in light of implications for competition, for financial integrity and stability, privacy, and free trade of digital intensive services. So I want to share 3 recommendations from the task force. First is very important that placing people at the center of the global financial system. Digitalization must be driven by the needs of the people and work for them. Second, connecting citizens to mitigate the digital divide. Over 700 million people lack broadband connectivity, while over 1 billion lack formal identification. These infrastructures are critical to leverage these technologies. And third, strengthening the governance of global digital financial platforms. The so-called big techs are transforming the delivery of services globally, including in developing countries. However, developing countries have not been at the table when the governance of these reforms platforms are discussed and decisions are taken. One of the task force key initiatives is the dialogue on global digital financial governance that seeks to facilitate a balanced and more inclusive dialogue, particularly involving developing nations and better aligning fintech and big tech governance to sustainable development goals. I'd like to move to the work that we are doing at the fund, which is related to some of the issues you will discuss today around distributed ledger technology, digital currencies. So the CBDC, GSC, and global cross-border transfers are really important areas of work for us. In the public sphere, we know that over 50 central banks around the world are exploring central bank digital currencies. Most are in very early stages, but a handful have progressed to pilots. Interest in CBDC stems from some of their potential benefits. They could strengthen the resilience and efficiency of payment systems through lower costs, faster settlements, and greater competition for private solutions. They could also improve financial inclusion, and depending on the design, they could spur innovation in the payment space. However, without careful design, CBDCs could also pose risks through disintermediation of the banking sector, potential bank run risks, and central bank operational risks. These are not necessarily large risks, but they need to be really monitored carefully. The private sector may follow a separate path, that of developing stable coins that could become truly global stable coins if they are issued by major big techs with large established user bases. And these innovations do have the scope to provide financial and social benefits, such as lower costs and ease of use, particularly if they are integrated with other mobile services. So, however, GSCs could introduce risks, as I mentioned, to consumer protection, market contestability, privacy, and the conduct of monetary policy. Given our mandate, an area of particular interest for the fund is potential implication of cross-border use of digital currencies. On the positive side, such use could overcome some of the limitations of existing cross-border payment systems, making them cheaper, faster, transparent, and more widely accessible. But we also see that there are some macro financial risks. We have been doing some analysis. For instance, in some scenarios, currency substitution could occur, limiting domestic monetary policy room to absorb shocks. Widespread adoption of digital money could undermine financial stability by exacerbating currency mismatches and raising the importance of global factors in domestic monetary conditions. At a global level, widespread adoption of digital currencies could eventually affect the configuration of the international monetary system, although large changes are unlikely to materialize abruptly. The benefits of digital money, at least for cross-border transactions, are conceptually clear, but to achieve these benefits, the macro-financial risks need to be addressed, as I mentioned before, and this requires collaboration and cooperation. We are actively working with the FSB, BIS, CPMI, the OECD, and the World Bank, as well as with a number of national authorities, to implement an ambitious roadmap to enhance cross-border payments. On the domestic front as well, the IMF is providing technical assistance to an increasing number of countries to help them evaluate the implications and feasibility of adopting CBDCs and to ensure that these are designed to support financial stability, financial integrity, market contestability, and consumer protection. So to summarize, the pandemic provides us with a once-in-a-lifetime opportunity to accelerate this work, make sure that it works for everyone in the world. And it's really important that we take this opportunity and discuss how this can be disseminated and provided to those that really need it the most. And as I mentioned, those are people who don't have access, and SMEs, which really are the employment generators. Thank you very much, and I look forward to the discussion. Over to you, Caroline.
Thank you very much, Ceyla. That was fantastic, really putting the work that we're doing here on, at the Blockchain Policy Centre into a bit of a global context.